Welcome to a video where we'll be discussing what is market velocity, and we'll be looking at it with reference to firstly the speed of exchange, so the speed, and then we'll be looking at it in reference to the auctioning activity, so we'll just call it the auctioning activity of the price area that we're looking at, and then we're looking at the relative auctioning speed of the day. So relative auctioning speed of the day, and as well as the relative auctioning of the price zone. So relative auctioning of the price zone. So these are the three main areas that we will be looking at. So four main areas. So the speed of the exchange, as well as the auctioning activity and the progress of the auctioning, the relative auctioning speed of the day, and the relative speed of a particular type of price zone. And this really starts summarizing what I'm trying to illustrate here and make you understand what a market velocity is. And it is so critically important to understand what market velocity is, because by understanding market velocity will really start helping you how you're going to manage your risk, how you're going to manage your conviction trades when all of a sudden the price ladder is showing you certain types of activity that will determine whether you observe it's picked up absorption, flipper, or a momentum play, or a reversal area. So all very key, critically important considerations. So what I'm going to do now is I'm just going to start playing this video, and I just want you to really listen closely what I'm looking at, and I'll be bringing this to your attention with my pen over here. So what are we looking at over here? Now you've just seen, and let me just make this a little bit smaller. So you've just seen over here 15 lots lift the offer. Okay, so 15 lots traded through. Now you can see it's the last time. Now we've had another about 130 lots in the cumulative quantity. But the speed of this, exchange is rather lethargic and rather slow. You can see the market has spent a lot of volume in this area over here. This is traded, for most of the session in this little zone over here, and you can see the market is really going in a very lethargic way, because it's going in at about potentially 100 lots per 15 seconds. So as opposed to high speed is when this number is changing rapidly. So when this number all of a sudden, so 30 then becomes 50, then becomes 60, becomes 70, now, and then the bid and the offer are exchanging, and the speed is going high. And I always call it the amount of lots being traded per second, or per 10 seconds, or 20 seconds. So as you get to know your market intimately, you start understanding what high speed is and what low speed is. And what's happening is that as the market has really been trading in this area, we're really trading in a very lethargic type of manner. And as the market has kind of traded up and it's lost any type of speed, well, you can see in this instant that the trader is now actually short here, 10 lots at the 65s, looking for a potential move to the downside, because it feels that, well, if it were to be a momentum play and the market were to really start moving aggressively to the upside, you want to start seeing the speed of how many lots can you trade per 10 seconds or per 30 seconds really increase or pick up in activity. If the speed and activity starts picking up as the market progresses towards the upside, well, then you'll potentially have to start covering the trade. And so now let's look. Now what I'm going to show for you now is you've been watching this very closly. Okay, you've been watching the speed on by the volume profile and how many orders are going through the order book. Now if we start speeding this up, you really start to notice, if you start speeding this up, let's speed this up a little bit for you, and this is how the market can move at a particular point in time. So if all of a sudden the market activity, now if you see over here, now I've actually just speeded this up 4 times, but what I'm trying to illustrate to you, the market can pick up its speed quite phenomenally. Now you can see that that all of a sudden the speed per lots being traded is a lot quicker. So let's ignore time, because time is 4 times quicker now. But assume this was normal trading activity, and whatever we saw over there, that speed, the moment the speed changes, its personality. So it shifts the gear. It shifts from first gear to fourth gear. All of a sudden, you want to start paying very close attention, because when you start paying that very close attention, you can start actually seeing the underlying dynamic that's going in the market, and you can start seeing potential absorption, which we look at later on in the modules, or particular types of activity coming from the other time frame participants. So all of a sudden, the speed is starting to increase. And so if you watch a market shift from first to fourth gear, that's when you start saying, well, if it's shifting from first to fourth gear towards a key potential technical breakout level, well, the likelihood of a breakout towards the upside starts increasing at a rather rapid rate. So if the speed picks up, so if the market moves from a lethargic area and it goes up high, and all of a sudden the speed starts increasing, well, then the likelihood, the probability of a breakout starts increasing rapidly. So this is really important to understand when you're watching your ladder, understanding the speed of the market. Now, what do I mean by the auctioning activity? So what I'm going to show you over here is we're going to look this down in normal time again, and we're going to look at. Now, we've just covered speed and what I mean by speed. Remember, the higher the speed, as we look through the rest of this module, the higher the speed, especially momentum plays, as the market approaches key areas and the speed starts picking up, then the greater the chance of the market breaching technical boundaries, provided that once it's breaching those boundaries, the market is continuing in that direction and the speed doesn't become lethargic, but instead starts picking itself up. So we've just looked at speed. Now let's look at auctioning activity, the level of auctioning activity. So what I mean by the level of auctioning activity. Now, if you have good speed going through the market, lots of lots being traded, but if the market is auctioning on both sides, so all of a sudden there's a seller, so the seller sells 300 lots, and then the buyer buys 300 lots, and the seller buys 300 lots, and then it moves to the next price, and the same process evolves, as opposed to, so that's good auction activity, is that there's two-way exchange. But say at the market all of a sudden, so we're looking at that, so say all of a sudden the market goes to 67, takes 240 lots out. Let's actually just freeze this for a moment so we can look at this order book. So say all of a sudden we are trading here now, there's 133 lots. All of a sudden someone buys 133 lots. Then no one sells it. Then the next buyer, so the market's trading bid 67s. The next buyer comes in and buys 476 lots. It trades and no one sells into that bid. Then the next buyer buys 540 lots, and it keeps on going up. So what's happening now is that the market is going up, but it's not going up with any auctioning activity. And a lot of times when it goes up with no auctioning activity, the likelihood of a reversal becomes quite great, because it wasn't built on a strong foundation. A strong foundation for prices to keep on advancing is if the market exchanges both sides. So as long as there is a marketplace and there's auctioning, the market will keep on bidding and sustaining its bid, provided there's auctioning on both sides. So for example, 133 lots get taken out. Then there's a 200 lot sitting bid. Then all of a sudden someone sells into a 200 lot. And then there's 300 lots sitting over there, and then someone buys 300. What you're having auctioning activity. You're having, at a price, the market is auctioning. And if it does that at the next price, the market is auctioning. And if it does it at the next price, the market is auctioning. Until it gets to a moment when all of a sudden the market stops doing that, and it goes bid over, the offers disappear. Then all of a sudden you might get a flurry of a move, but that could potentially be the reversal. So understanding these little subtle shifts in the price ladder really stands you in good stead to understanding if a market can continue in its direction or if the market cannot. But when you have good speed and good auction activity, the likelihood, as we look later on in one of the modules, the likelihood of good momentum plays and breakout trades happening. So you really want good auctioning activity, and this is how we set out all our price ladder analysis later on when we look at a whole host of different videos and looking at the market velocity to determine the degree or the lack of degree of success of the trade idea. So this is really critically important. So we've looked at this speed and auction activity. Now let's have a look at the relative speed of the day. Now what I'm trying to explain over here is, say for example, on the day, okay, so what I'm going to do over here, say on the day that what starts happening is that the market on the one side, so say this is the high of the day, okay, so let's draw this. Say 67s is the high of the day, and in this area here, you know, at 67s, the speed that's going through is slow, is tired, is lethargic. What do I mean by slow, tired, lethargic? I mean that the speed is low, so only 10 lots being traded per 10 seconds. The auction activity is non-existent. There's hardly anything going through, there's hardly any orders going through on the ladder. No one's really exchanging on both sides. And we observe that, and all of a sudden the market says, you know what, I'm not finding any auctioning activity. I'm not finding any interest up here. Then all of a sudden the market starts slowly then drifting downwards. As the market is always in a state of disequilibrium, looking for an area of interest. So after the market auctions up and it finds no activity, then the market starts auctioning down to look for a new party. And it wants to go find that party where there's lots of people at it. So all of a sudden it auctions down, and all of a sudden the speed starts picking up. So what I want to start doing over here now, I want to actually fast forward. So what was actually happening on the day in this video is that you can see, if you look over here, the auctioning, it's 40 lots is traded here now. Now look, 1, 2, 3, and 1 lot in the last 3 seconds. 1, 2, 3, another 2 lot. Okay, 25 lots, but really slow. Now I really want you to cement what I've just showed you here of how slow the activity is. Now what I'm going to do is I'm going to bring this video a little bit forward. So what I'm saying is, you've noticed the relative speed of the day. So the relative speed at this moment and at this part of the range is really low. So if I now go and move this, a little bit further, so this person still held on to the shorts. If I go now and move this, okay, a person's actually added into a short position here, so you've still got, so I've got to move. Okay, so now the market's going towards the low side of this range. So now what I want you to observe here is, now let's watch. So you watch the speed of how quick it was going up there. Now look over here, already the orders are going through a little bit quicker already. And as we watch this, I really want you to really start, observing this speed change. And as you can see, at the moment, the market is trading towards this, towards the low extreme of the current day's range. And if I just fast forward a little bit more, okay, now you can see that the market is approaching the low of the day, and then the orders are starting to go through. The speed isn't that intense at the moment. It was a little bit more intense over there. So we just go a little bit further forward over here. And we just start watching this market. We just start watching this market trade. And all of a sudden, you're starting to see, okay, 1 lot has hit the, has hit the 54s. We have another 1 lot above there, and we're still seeing nothing really that's bringing much interest. The reason why this person, or the reason why there was a short over here, because thought that the market lost its interest up here, so finding a short towards the lowest side of the range. And now we're having a look at at the activity. So all of a sudden now we've had a 230 lots go through. So we're at 56, 230 lots, and we still continue to watch this very, very closely, and we're seeing activity. And effectively, what you're wanting to see is, all of a sudden, you want to see this speed start picking up to relative to where it was up there. So all of a sudden, you're seeing you're seeing a little bit more activity. There's a little bit more interest going on down here, and really, when you see it, observable interest. It's not quite observable yet to the untrained eye, but all of a sudden, the speed of this area is starting to pick up. So, and there's auctioning that's happening on both sides. So, they're offering and then they're rebidding. They're offering and then they're rebidding. And there's trading going on here. There's 500 lots that has been traded over here at the moment. And all of a sudden, there's an extra 100 lots. And as the speed starts picking up, you really want to start seeing, and in an ideal scenario, what I'm actually going to do now is just forward this a little bit quicker, is if all of a sudden you start seeing the speed pick up a lot more. So you see the 1 lot, the 11 lots, and you'll notice this, it's not, in this example, you start seeing the exchange really, really going through on the market. And when you start watching this, the level of the progress of the move towards the downside starts becoming greater. So that's what I mean by the relative speed of the day is. So you're looking at, well, what did it do up there, and what is it doing down here? If the speed over here is higher than that speed, the likelihood of progress towards the downside is greater versus the upside, because it's showing you a different area of exchange, and you can see the orders that are going through a lot more aggressive, because we knew that down there the orders were slow. Now look how quickly this is starting to go through. We've actually we're going through very aggressively. The orders are going through a lot more aggressively, and because you know how the market traded on that side, you have more conviction being short on this side. So really critically important to really understand market velocity, because it helps you really structure your trades more effectively. And just the last point is a relative price zone. It's the same as the relative speed of the day. The relative price zone, well, if you know that the market was trading over here in a price zone between 63s and 68s, and in that price zone it was trading at really slow and lethargic, but also in this price zone there's a lot more trading activity. There's a lot more trading activity over here. So there's a lot more trading activity here. Then all of a sudden you're going to be happy being short on this side. You're going to be happy until the relative price speed starts slowing down. And when it starts slowing down, you start booking your profits potentially. This person's now eventually booked his profit down there, but it's one of the traders who was looking for this trade. But really important to understand market velocity. So effectively, again, just to summarize, you're looking at the speed of the exchange, the level of auction between the buy and the sell side. You want to always know the relative speed of the day, because each day is unique, or each week is unique. The relative speed of the highs versus the lows. So when the market turns over, you can be convicted on the one side. So all very important considerations when you are looking at market velocity. And to me, this is one of the most important things. This is the foundation. Once you understand your market velocity and you're able to seize up the velocity that's going through the market, it helps with your ability to determine absorption plays, especially momentum plays, breakout plays, and then stands in really good stead to structure really powerfully well-structured trades.